Well, good afternoon, ladies and gentlemen. My name is Russell Higgins and I'm the Chairman of Argo Global Listed Infrastructure Limited, which we refer to as Argo Infrastructure, or ALI for short. On behalf of the Board of Directors, I'm pleased to welcome you to the 8th Annual General Meeting of the company and to report on its operations and financial results for the year ended 30 June 2023. It's good to be able to meet here in person in Adelaide again today, and it's good to have the shareholders here and visitors. You're most welcome. To begin the formalities, I'd like to inform you that the meeting is being filmed and streamed live on the company's website for shareholders who are unable to attend. A recording of the meeting will be available via our website later in the day. Can I please request that your mobile phones are turned to silent? I've been informed by the Company Secretary that the meeting has been convened in accordance with the Corporations Act and the company's constitution. A quorum is present and therefore I declare the meeting open. A disclaimer is displayed before you on the screen, and it's important to understand that the information presented today is general information only and is not a securities recommendation or statement of opinion intended to influence any person in making an investment decision. You should consider seeking independent professional advice before making any significant investment decision. I'm pleased to ask my fellow non-executive directors, our Managing Director and Company Secretary, to introduce themselves.
Good afternoon. My name is Mark Hall. I was appointed to the board as an independent non-executive director in 2019, and I'm chair of the Audit and Risk Committee. I'm standing for re-election today, so you'll hear from me later in the meeting.
Good afternoon. My name is Fiona Hill. I was appointed to the board in 2022 as an independent non-executive director, and I'm a member of the Audit and Risk Committee.
Good afternoon, everyone. I think many of you actually already know me, but I'm Joycelyn Morton. I was appointed to the board on incorporation in 2015 as a non-independent, non-executive director, and I'm a member of the Audit and Risk Committee.
Good afternoon, ladies and gentlemen. My name's Jason Beddoe. I'm the Managing Director of ALI. I've been so since IPO. I'm also the Managing Director of Argo Investments. Welcome to the meeting, and I'll also speak to you a little later.
And I'm Tim Banks. I'm the Company Secretary. I've been with ALI since IPO, worked through the IPO with Jason and Joycelyn, for that matter. I'm also Chief Operating Officer and Company Secretary of Argo.
I'd also like to introduce to you Ben Morton, who's the Senior Portfolio Manager from Cohen & Steers, which manages Argo Infrastructure's portfolio. Cohen & Steers, who's located in New York, manages over $100 billion for a range of clients around the world and were pioneers in the development of the global listed infrastructure class. Given the time difference to New York, Ben has recorded some commentary regarding the global infrastructure and our portfolio, which you'll hear later in the meeting. You may recall that since the COVID restrictions have been lifted earlier this year in May, we conducted a series of information meetings for shareholders in capital cities. And Ben was out here in Australia for that, enabling shareholders to ask him any question they wanted and interact with them in a more informal sense as well. It's our intention to continue those information meetings in the future. We'll now move on to the meeting procedures. All resolutions at this AGM will be decided by poll. As chairman, I've called that poll. When registering your attendance, you will have received either a blue, orange or white admission card. Shareholders or proxy holders representing shareholders were issued with blue admission cards and are entitled to vote on the poll and ask questions at the meeting. On the reverse side of your blue admission card is your voting paper and instructions. Only those shareholders with a blue card have received a voting paper. This can be marked at the time we consider each resolution or at any other stage during the meeting. After the meeting, you can place your completed voting cards in the boxes located by the exit doors. The results of the poll will be released by ASX announcement later today. The holders of orange cards are non-voting shareholders, such as a joint holder when the other joint shareholder holds the blue voting card. These card holders are not entitled to vote on the poll, but are entitled to ask questions at the meeting. All visitors were issued with white cards and not entitled to vote or to ask questions at the meeting, but nevertheless you are extremely welcome. I report that the minutes of last year's annual general meeting were confirmed as a correct record at the subsequent meeting of directors. The notice of meeting for today's meeting has been circulated to shareholders and I propose to take it as read. I now move to the first item of business. It concerns the consideration of annual financial statements and reports. The audited financial statements of the company and the report of directors and the auditor for the year ended 30 June 2023 have been published and made available to shareholders. In the course of receiving and considering financial reports, I'll now make some general comments about the year under review. This will be followed by a brief address from our Managing Director, Jason Beddoe, and the Portfolio Manager's commentary from Ben Morton of Cohen & Steers. For the 2023 financial year, Argo Infrastructure delivered a solid performance and a record high annual dividend. Argo Infrastructure's full-year profit was $9.6 million. This was lower than the prior year, largely reflecting the decline in the market value of Argo Infrastructure's investment portfolio, in line with the broader asset class. Accounting standards require that changes in the value of the portfolio be treated as a profit or loss for ALI. As a result, reported profit can fluctuate significantly from one year to the next and may not reflect the level of income generated by the portfolio, as was the case this year. Income received from companies in the investment portfolio this year increased by 22.5% to $14.4 million. It is this income, together with realised capital gains and the tax that we pay on them, that enables us to pay franked dividends. In August, the board was pleased to declare a fully franked final dividend of 4.5 cents per share. Together with the interim dividend of 4 cents per share, annual fully franked dividends increased to 8.5 cents per share, marking a record high for the company. Total dividends paid to our shareholders since the company was founded now total 48.75 cents per share. Furthermore, the final dividend marks Argo Infrastructure's 11th consecutive fully franked dividend out of the 16 dividends paid since inception. Global infrastructures have favoured growth-style investments, particularly technology stocks, over the last year. And as a result, global listed infrastructure has lagged the strong performance of broader global equities. Over the 12 months to 30 September 2023, Argo Infrastructure's portfolio return before fees and in Australian dollar terms was flat. This is in line with the performance of the benchmark infrastructure index, which was similarly flat, increasing by just 0.1% in Australian dollar terms over the same period. Argo Infrastructure's Managing Director, Jason Beddow, and Cohen & Steers Portfolio Manager, Ben Morton, will further discuss the factors contributing to the subdued performance of global listed infrastructure last year, particularly relative to broader global equities. The discount of Argo Infrastructure's share price relative to its net tangible assets backing has narrowed over recent years and on some occasions traded at a premium. Over the past 6 months, however, this discount has widened again to be in the high single-digit range. Over this period, all listed investment companies have experienced this phenomenon, which has coincided with the rapid rise in interest rates, making term deposits viable investments once again. We recently conducted an online survey of our shareholders. The purpose was to better understand Argo Infrastructure shareholders. No, let me go back. Sorry, I've turned a page too many. I want to make a very important point here. So we've had a widening of our discount of NTA to share price to NTA, and that's also coincided with subdued performance of global infrastructure. And as a result, we acknowledge that the performance of the NTA and share price has been disappointing, largely reflecting the overall weakness of the asset class. However, independent research from Lonsec recently published its 2023 report on Argo Infrastructure, and I'm pleased to advise you that Lonsec reaffirmed its recommended rating for the third consecutive year. In addition, Independent Investment Research, or IIR, another research house, has maintained its recommended rating for the company. I now do turn to those shareholder survey results. We recently conducted an online survey of our shareholders. The purpose was to better understand Argo Infrastructure shareholders and how we can improve our communication and engagement. We would like to share the key findings of the survey with you today. 60% of respondents have been Argo Infrastructure shareholders since the company's inception in 2015. More than 3/4 have been shareholders for 3 or more years. The top 3 reasons why shareholders own Argo Infrastructure shares are: firstly, seeking global diversification for their investment portfolio. Secondly, gaining exposure to infrastructure. And thirdly, receiving fully franked dividends. 70% of respondents rated our overall shareholder engagement and communication as very good and excellent, or excellent, and 97% described the quantity of information provided as about right. Emails are by far the most popular form of communication, with 86% of shareholders nominating emails as their preferred method of accessing information about the company. And importantly, 84% of our shareholders would recommend Argo Infrastructure to other investors. I want to thank all of those who completed the survey. If you did not have an opportunity to participate, or you have further comments or suggestions, we welcome your feedback. You can be in touch with the team at Argo Infrastructure at any time, and contact details will be provided at the end of today's session. I now turn to the outlook. While the higher for longer interest rate environment is a headwind for global infrastructure stocks currently, the outlook for the asset class over the longer term is supported by several factors. Some of the structural changes occurring in the global economy are a boon for infrastructure and necessitate major investment in projects across the world. For example, the rapid digitisation of society will require more supporting infrastructure such as data centres and communication towers. Similarly, the enormous task of transitioning to net zero emissions will see the world's largest economies ploughing large sums into energy infrastructure. We're seeing this play out in the United States with the Inflation Reduction Act mandating massive government expenditure in this space. In addition, the urbanisation of populations across emerging economies will require investment in new projects across the full spectrum of infrastructure subsectors, from water utilities to airports. With just a handful of Australian infrastructure stocks remaining on the ASX, we offer investors broader access to these and other long-term global infrastructure trends. Furthermore, we remain the only Australian listed company that provides exposure to the large and diverse universe of global infrastructure stocks. Argo Infrastructure has established a track record of providing diversification benefits to investors in Australian equities, and we remain focused on providing shareholders with a steady and sustainable stream of fully franked dividend income. I can assure shareholders that Argo Infrastructure remains in a strong financial position with approximately 400 million of assets and no debt. I'd like to conclude my remarks today by thanking our Managing Director, Jason Beddoe, and the team for their ongoing hard work, and also like to thank Ben Morton and the team at Cohen & Steers. And I also wish to acknowledge the hard work and contribution from my fellow board members during the course of the year. And finally, on behalf of the board, I warmly welcome and thank our loyal shareholders, and to our new shareholders, welcome to Argo. I now ask Jason to provide his Managing Director's address. Thank you.
Afternoon, everyone. Certainly been changing times. The rapid tightening of monetary policy over the last 12 to 18 months has weighed on returns from more long duration investments globally. And this includes global infrastructure stocks. This is particularly the case for utilities, which can carry considerable debt due to their reliable income, which is derived from the provision of essential services, effectively electric, water and gas. And these utilities dominate the global listed infrastructure universe, and their recent poor performance has been a significant drag on the performance of the overall asset class. In the wake of the steepest interest rate hikes in recent history, the relative underperformance of utilities and global listed infrastructure more broadly is not unexpected. Maybe the pace and the extent has been, but certainly not the profile. As the monetary cycle matures and interest rates are potentially cut, it follows that returns from global infrastructure stocks would revert to average long-term returns. That said, the timing and pace at which interest rates may fall is unknown. The underperformance of the asset class relative to broader equities also extends to Australian infrastructure stocks. Among the remaining locally listed infrastructure companies, these three are salient examples. And for a long time, I guess, were cause of a lot of Australian shareholders' portfolios, APA Group, Transurban. And this really highlights how the fortunes, at least short term, has changed for them as well. So these companies have all seen their share prices materially underperform the broader Australian share market since the Reserve Bank of Australia started aggressively raising rates in May of last year. So the underperformance of these infrastructure stocks also demonstrates the low correlation of global listed infrastructure with local equities. Historically, the asset class also displays this attribute during market share downturns. This was illustrated in financial year 2022, when it was almost a mirror. The Australian share market fell 6.5%, and in contrast, global listed infrastructure gained 12.3%, so outperforming local shares by over 18%. So we believe global listed infrastructure's low correlation to the Australian share market is still one of the diversification benefits that Argo Infrastructure provides. Shortly, you will hear from Ben Morton, Head of Global Infrastructure at our Portfolio Manager, Cohen & Steers. As the Chairman mentioned, Ben was out in May. It was good to sort of have him here in the flesh for those that were able to make it. And we do intend to have an annual out-of-cycle, roadshow. But he will discuss further the relative performance of the asset class, as well as other factors shaping the investment environment as they see it, including the elevated inflation, higher for longer interest rates, which seems to be the more recent trend, as well as specific infrastructure subsectors and stocks. Before I hand over to Ben, I'd like to acknowledge the efforts of the Argo team again this year. Also, I'd like to acknowledge the contribution from the Chairman and the non-executive directors. I look forward to working with them over the sort of challenging year ahead. And finally, thank you to our shareholders, those that are new and those loyal long-term shareholders, 60% who have been here since IPO. So thank you for coming.
We're now going to hear the commentary from Ben Morton from Cohen & Steers. So if you could cue that for us, please.
It's been a challenging year for global listed infrastructure in 2023. I'm going to go back and talk a bit about the context in which the asset class performed this year by first starting with a review of performance in 2022. Now, again, 2022 is a period that was characterized by very specific macroeconomic drivers, one of which economic growth, which was slowing, inflation, which was rising quickly, and interest rates that were up over the period. This is typically a great period for infrastructure performance, both relative to its historical performance, but also relative to other asset classes. So 2022 was a year in which infrastructure outperformed both equities and fixed income by around 15%. Now, as we transition to 2023, we're talking about a slightly different macroeconomic picture, right? So we had factors such as interest rates, which continued to rise and rise substantially. We had inflation that remains above trend, but has fallen and fallen significantly. And an economic outlook that has proven to be a bit more resilient, I think, than many expected beginning of the year. So what we've seen this year is infrastructure lagging the market substantially in other asset classes. So infrastructure is down around 8% year to date through September 30th. Global fixed income down around 2%. Global equities up around 11%. I would note that a lot of that global equity performance is concentrated in tech-related sort of AI businesses. But nonetheless, infrastructure has lagged global equities as measured by nearly every sort of global equity index. Within the context of that underperformance, let's just talk about both geographic and subsector level performance. So when we think about subsectors of infrastructure, what's performed well and what's lagged, let's start with what's lagged. Simply put, the things that have lagged are the parts of our asset class that tend to have more rate sensitivity. Particularly those that have, heavy leverage and long duration assets. So in our world, that is utilities, both water, electric utilities, gas utilities, and telecom infrastructure, notably cell tower companies. Those have been the worst performing parts of our universe this year. The better performing parts of the universe tend to be this year tied to reopening. So transportation. Notably passenger transportation. So airports have been the best performing part of our universe, largely again on reopening and the sort of last phase of reopening coming out of the pandemic, which has seen China really start to open their borders in a much more material way So we've seen international travel up significantly. Then beyond that, we've seen some outperformance within the group from some of the more freight-oriented businesses. So marine ports, freight railways have modestly outperformed the broader asset class. When we think about different geographies, clearly that's been more subsector driven. What I mean by that is Europe has been the best performing geography within the infrastructure universe. Why is that? It's because of a large concentration of more transport-oriented businesses there. So airports, for example, a significant portion of the European infrastructure universe, toll roads also. If we look at the worst performing part of our universe, it's the Americas, notably the United States, where you've got a significant concentration of tower companies as well as utilities. There are a couple of themes that I'd like to address that we've spoken about in the past quite a bit, and one of which is dry powder, right? We've made the case over the years, and a case that's accelerated recently, that an increasing amount of capital has been raised by infrastructure vehicles on the private side would ultimately find their way into the listed markets. The reality is that was a big driver for performance within the listed asset class over the past several years, as our companies began to really start to either sell assets, sell stakes in assets, or in some cases even sell themselves to private infrastructure vehicles. So we call this, again, the dry powder thesis, which was a big part of our sort of discussion around the asset class over the past 5 years. The point that I'd like to make today is that continues to be a driver, although I would say that this changed world from a cost of capital perspective that's impacting not only listed companies, but also private companies, has really slowed down the activity when we think about dry powder. So 2 implications for us. One, we still think there is a valuation floor that's driven by all this dry powder on the private side that ultimately has to find its way into the market. But we do think there's going to be a little bit of a lull in the action in terms of the amount of activity that we see. Second, I think, there are a handful of companies within the infrastructure universe that are relying on asset sales to improve their balance sheets. And as, investors in the asset class, we have to be aware of those cases and be realistic about the ability to get those deals done and the ability to do them at attractive prices. So a lot going on still on the dry powder side, but something that is very front of mind as we think about this new regime that we're in from a cost of capital perspective. The second theme is energy transition, right? So we've talked a lot about energy transition and the implications on infrastructure. So a big part of the energy transition story relates to renewables and the movement from traditional fossil fuels to renewable energy. And that's entailed, investing by a lot of utilities in not only renewable energy generation assets, but also transmission assets to support the movement of that energy from the places where the wind blows and the sun shines to places where that energy is consumed. Now, we still believe that story is intact, but we'd like to change the narrative a little bit when we think about this transition. We want investors to remember this is not just a transition. We think about it as an energy addition. The world will continue to need more energy, and generally energy of all types, meaning we think natural gas is going to continue to play a significant role in the ultimate energy transition to renewables. So at times we've thought that the pendulum swung a little bit too far, too fast towards renewables. And we just want to make sure investors recognize that there's going to be a significant amount of growth in demand for natural gas, and that creates some really interesting opportunities for infrastructure companies. So midstream energy is one of our favorite subsectors within the infrastructure asset class. These are companies, again, that own and operate a number of energy infrastructure assets. So typically pipelines, processing facilities, storage facilities. These are businesses that, historically were spending a lot, investing a lot on new assets. I think what has changed over the past 5 to 7 years is that these companies have been a lot more disciplined. We have built out the vast majority of the energy infrastructure that we need in North America. And as we've just talked about, we do think that there are significant demands for traditional sort of energy infrastructure, even with this transition to an increasing market share for renewables. So simply put, we think these businesses are very attractive. We think that financial discipline has returned. These companies are paying out very attractive dividend yields and in fact growing their dividends at substantial rates, generating as much free cash flow as any infrastructure subsectors that we focus on. They tend to be North America focused companies. That's because most of the independent midstream companies are domiciled here. These types of assets in other parts of the world are typically owned by governments or owned by much larger energy conglomerates that tend to have more commodity price exposure, which is something that we're looking to minimize in our portfolios. These businesses perform well when production of energy is growing in their specific regions, and that is something that we've really focused on in our portfolios. So midstream energy, again, it's a changed game when we think about their capital discipline, and we expect these stocks to continue to perform well, having been among the best performing businesses within infrastructure over the past 2 years. So we expect both the U.S. and global economies to slow as we move into 2024. A number of factors leading to that slowing growth that probably leads us to a place that we're below trend on both. In fact, growth in the U.S. we expect to average around 1% in 2024, down from 2+% here in 2023. So why is that? It's the lagged impact of the tightening that we've seen over the course of the past couple of years. Some of that relating to inflation, clearly that we do expect to come down, but still stay well above trend, let's say around 3.5% as we move through 2024, which remains above consensus from our perspective, but also, the higher rates that we've seen filter their way through the market. And that clearly will have an impact on businesses, but also at some point here on consumers, on employment, et cetera. So we definitely are thinking about a growth slowdown as we move into 2024. Again, not only for the U.S., but also globally. Another factor as we think about 2024 will be the election here in the U.S. And while these things are very difficult to predict, it seems fairly clear at this point that both Trump and Biden will be serious about running in 2024, and hard to imagine that there's going to be legitimate contenders for either party as we move through that process. So our best guess right now is it comes down to Trump versus Biden. If you look back, actually, there hasn't been an incumbent that has been reelected if the U.S. has moved into a recession during the later stages of their presidency. So if we want to know, odds of Trump versus Biden, keep an eye on the economy. We'll see how that plays out. But that's been the best indicator of incumbent success in elections in recent years. I know I noted interest rates before. I think, our view is 10-year Treasury hovering around 4.5%, which is certainly above the recent trend, as we'd know. But again, between that and inflation, we continue to think that we're going to be in a tightening environment from a cost perspective for both consumers and businesses, which leads to, again, a slowdown as we move into 2024. So we think, given all that background, infrastructure is poised to perform well as we move into 2024. Again, infrastructure historically has outperformed its long-term average in periods of slowing growth and above trend inflation, which again is a period that we think we're going to see. We're not suggesting that there's going to be a significant and deep recession, but we do think that there's going to be an economic slowdown that happens and has to happen given the tightening that we've seen. So we expect infrastructure to perform well in that context. Again, tough to say exactly relative to equities and fixed income, but certainly a rebound from its dramatic underperformance this year, in our view, is likely. When we think about valuations for listed infrastructure, they're trading significantly cheap relative to equities, given this underperformance that we've seen. Historically, infrastructure is traded at a 1 to 1.5 turn premium to global equities. Right now, infrastructure is trading at about a half a turn discount to global equities. So in a period that we think will return to a focus on predictability, giving slowing economic growth and high inflation, we expect, or above trend inflation, I should say, we expect that premium to again return to infrastructure, given again its predictability of cash flows and historical performance pattern.
Well, thank you very much, Ben. So Mr. Josh Hall, who's the signing audit partner from the company's external auditor, Ernst & Young, is present at the meeting and able to answer any questions relevant to the conduct of the audit and the preparation and content of the auditor's report for the year ended 30 June 2023. Shortly, I'll address any shareholder questions on the financial reports and any general matters, bearing in mind that we'll separately consider the remuneration report and other items of AGM business later in the meeting, at which time there will be opportunities to ask questions relating to those items. To ask a question, please ensure you have your blue or orange card and make your way to one of the microphones in the middle aisle. Be grateful that you can state your name and any affiliation that you have when you're invited to speak, and to limit yourself to one question in consideration of the other shareholders. So, are there any general questions or comments about the company or its financial report at this time?
My name's Colin Pilcher. I have a general question. I'm not uncompleted yet, but what do you mean by, or what does the company mean by infrastructure? And I ask this like, I know that AGL's not or Origin's not a world player, but would Origin be classed as infrastructure or what? Because they own infrastructure, but they also get a lot of their income from selling electricity as well in the open market. And are we just talking about railways and they do nothing else? But, you know, then you've got airports and they have all this infrastructure underneath where shops and you know, they rent out the shops and all this sort of stuff. So what would be classed as infrastructure broadly?
Thank you, Colin. Well, AGL and Origin, generally speaking, are not classed as infrastructure companies because their main business is retailing energy. Origin, of course, has a big LNG business, which I'll come to in a moment. But both Origin and AGL, as it happens, sold the vast majority of their infrastructure to APA Group when I was on the board of that company. So they sort of concentrated on the retail end of their business. Origin, of course, has this upstream gas business and LNG export. And when you look at infrastructure, upstream oil and gas is not considered part of the asset class, but what's called midstream, so that's the gas transmission pipelines and gas processing in certain cases and storage and so forth, that is considered infrastructure. So it's not, you know, a definition you can nail down absolutely every little bit on, but to give you a general idea, yes, where the main business is operating infrastructure assets, that's considered infrastructure, and where your main business is either, in that case, upstream oil and gas or retailing or whatever, it's not. If that's a help. And of course it includes airports, as you say, which are, you know, shopping centres as much as they run airports for sure. But it does include airports and marine ports, railways, the gas, water and electric utilities that have, you know, the poles and wires and pipelines and so forth to deliver the energy. communication towers and data centres. I'm sure I've left something out, but look, it's a broad asset class, but it's concentrating on assets that are used as a part of our economy where the main business is owning and operating the assets. Thanks, Colin. Any other questions? Yes, Colin, go ahead.
I know Cohen Steers is a professional, and I haven't got a problem with that, but the relationship with Argo and Cohen Steers, what do they buy it and then tell Argo Infrastructure or the board that we've bought it, or do they put it up to the board and then the board give it the okay, or how does it work when you're buying and selling an asset?
Yeah, thanks. I'm going to ask Jason to answer this one in terms of the everyday operation, but Cohen & Steers is the portfolio manager. They have responsibility for making the decisions and managing the portfolio. Jason, perhaps you can talk about how that works in a day-to-day sense.
Yeah, sure. Now, look, Cohen & Steers run the portfolio independently of us. There is a benchmark, the FTSE benchmark, which has a lot of the subsectors that Russell was talking about, and we leave it up to them. I mean, that's what we're paying them for, is their expertise. There's certain systems, like I can log into a live system and see what transactions Cohen & Steers are doing and what the portfolio looks like. And certainly when we first set up the company, I was looking at that daily. Over time, as the relationship has, deepened, and we know what they're doing, we sort of leave them alone. We get very comprehensive monthly reports about their activity, which from my perspective is certainly enough. We also have a live system that tracks things. If, for example, they decided that they thought AI was pretty good and they might just slip an AI stock in, we get a notification that they've bought something outside of the index. We get a flag, and then we would certainly question that decision, notwithstanding that it may have doubled. So, look, it's run independently. They have a mandate to beat, but match that global index. They report through the management to the board. They present to the board a couple of times a year as well. So we think we have enough, access to what they're doing. But no, we want them to do that. They've got analysts around the world. They're a specialist in that field. So we don't want to second guess what they're doing.
Thanks, Jason. And then look, from a broader board and company point of view, we have a contract with Cohen & Steers, which comes to an end, and the board, in conjunction with management, will review their performance and make a decision about whether we extend that contract or seek an alternative way to manage the investment portfolio. And as part of that, as Jason said, we get regular reports to management and the board, and we have meetings with Cohen & Steers on a periodic basis through the year. Yes, Colin, go ahead.
Who determines how much cash you hold?
Yeah, it's Cohen & Steers. They run the portfolio. They decide whether they want to invest or hold cash. Any other questions? All right, thank you. We might move to the next item of business. Item 2 of the agenda concerns the adoption of the remuneration report. The Corporations Act requires that all listed companies submit a remunerations report to their shareholders for consideration and adoption by way of a non-binding resolution. Argo Infrastructure's remuneration report is detailed within the annual report. The remuneration report for this company is relatively short, outlining the company's remuneration of each of the 4 non-executive directors. As the company is externally managed, the managing director and other executive key management personnel are not paid by ALI, but they are remunerated by the manager, Argo Service Company Limited, as part of their roles with Argo. The non-executive directors receive a fixed base fee, do not receive additional fees for participating in board committees, and are not entitled to any other remuneration other than legislated superannuation entitlements. I now move the motion that the remuneration report for the year ended 30 June 2023 be adopted. Can I ask that any shareholders who wish to ask a question regarding the remuneration report specifically, please make their way to the microphones. For your information, details of the proxy votes received on this resolution appear on the screen. Please note that this resolution is advisory only and does not bind the directors of the company. However, should 25% or more of shareholders vote against the remuneration report for 2 years in a row, then shareholders at the second AGM will be asked to vote on whether all directors should stand for re-election. Are there any questions regarding the remuneration report? If not, I now put the resolution to the meeting. I remind you that we are voting by way of poll. If applicable, please mark your blue voting card for agenda item number 2. And thank you. We'll now move to the next item of business. As item 3 on the agenda concerns my own re-election, I will ask Joycelyn Morton to take the chair of the meeting for this item of business. Joycelyn.
Thank you, Russell, and good afternoon, ladies and gentlemen. Mr. Russell Higgins, AO, retires by rotation in accordance with the company's constitution and, being eligible, offers himself for re-election today. The details of Russell's qualifications and experience are included in the notice of meeting. The other directors unanimously recommend that shareholders vote in favour of Russell's re-election, as they consider he is well qualified to be a director and the chairman of the company. I'll now invite Russell to briefly address the meeting. Thanks, Russell.
I bring passion and experience to the role of chairman of Argo Infrastructure and a unique mix of skills relevant to the role. I have 30 years' experience as a chairman or director of listed companies, private companies, government business enterprises and international organisations. This experience has included a focus on infrastructure, including as chairman of Snowy Hydro, a director of APA Group, and many policy and regulatory roles during my executive career. My experiences span both Australia and overseas, including at the OECD in Paris. I was also, for a long period of time, a member of the governing board of the International Energy Agency, also located in Paris. And I was also chairman of the APEC Energy Group, which guided much of the APEC work on energy policy and infrastructure. Another role I've had as chairman of the Global Carbon Capture and Storage Institute. Our aim is to manage ALI to provide an investment opportunity that delivers diversification benefits to investors via an international asset class that has low volatility and low correlation with Australian equities, and to produce long-term returns via a mix of capital growth and a growing dividend stream. ALI has now established its credentials in that regard. We do that by bringing together the management and governance skills of Argo, who's been a successful Australian LIC manager for 77 years, together with the portfolio management skills of Cohen & Steers in New York, an experienced and successful global real asset manager. I believe that my skills and experience make me well qualified to chair Argo Infrastructure, and I seek your support for re-election to the Board of Directors of ALI today so that I may continue that endeavour.
Thank you very much, Russell. I now move the motion that Russell Allen Higgins be re-elected as a director of the company. Can I ask that any shareholders who wish to ask a question regarding this resolution, please make their way to the microphone. I don't see anyone, so for your information, details of the proxy votes received on this resolution appear on the screen. A simple majority of greater than 50% in favour is required to pass this resolution. Are there any questions regarding Russell's re-election? No, and there are no questions that were provided in advance. So I now put the resolution to the meeting. If applicable, please mark your blue voting card for item number 3. Thank you very much, and I'll now hand back to Russell, who will move to the next item of business. Thank you.
Well, thank you very much, Joycelyn. Item 4 on the agenda concerns the re-election of Mark Hall. Mark Hall joined the board as an independent non-executive director in 2019 and is chair of the Audit and Risk Committee. In accordance with the company's constitution and being eligible, Mark offers himself for re-election today by shareholders. The details of Mark's qualifications and experience are included in the notice of meeting. The other directors unanimously recommend that shareholders vote in favour of Mark's re-election, as they consider he's well qualified to be a director of the company. I now invite Mark to address the meeting.
Thank you, Chairman. Good afternoon, ladies and gentlemen. It's been a privilege to have represented you as an independent non-executive director since November 2019. As you have heard, over the last 4 years, ALI has navigated a volatile investment environment with the objective of providing investors with a mix of long-term capital growth and dividend income, as well as important diversification benefits. Over that period, we have grown our fully franked dividend, which our shareholders value highly. Personally, I have a deep interest in infrastructure investment and would be honoured to continue to serve you over the next 3 years. My executive career included 25 years in senior finance positions in complex global businesses. These roles necessitated deep skills in finance, commerce, taxation, governance and risk management. Skills I believe are highly relevant in effectively serving you as a director of the company. As Group Managing Director of Finance at Telstra, I was responsible for financial oversight of the annual $4 billion capital investment program. With significant infrastructure deployed globally, this involved navigating complex investment environments, in particular assessing, prioritising and monitoring capital investment to ensure optimal returns with appropriate risk management. Whilst Argo Infrastructure invests directly in listed infrastructure entities, an appreciation of the economics and risks of the underlying infrastructure investment is important. I have experience in capital markets, having successfully led capital raisings domestically and offshore. In terms of governance, my experience includes Audit and Risk Committee Chairman for the Telstra Superannuation Scheme, which at the time had over $16 billion in funds under management, including significant investments in global infrastructure. I was a director in over 25 Telstra subsidiary companies, both domestically and overseas, including Audit Committee Chairman for companies in China and New Zealand. I was also CFO and interim CFO at global ASX-listed companies Catapult Sports and Redbubble Limited. In a broader context, I was a board member of the Corporate Tax Association, and the group of 100 CFOs representing the interest of large business in Australia. I have graduate and postgraduate qualifications in commerce, accounting and taxation, and completed executive studies at Columbia University in New York. I'm also a fellow of the Australian Society of Certified Practicing Accountants. Over the past 4 years, it's been an honour to work with my highly experienced board colleagues and executive team, and I'd like to thank the board for supporting my nomination today. I will be delighted to continue to represent you and seek your support for my re-election to the Board of Directors. Thank you.
Well, thank you, Mark. I now move the motion that Mark James Henty Hall be re-elected as a director of the company. Can I ask that any shareholders who wish to ask a question regarding this resolution, please make their way to the microphone. For your information, details of the proxy votes received on this resolution appear on the screen. For your information, a simple majority greater than 50% is required to pass this resolution. Are there any questions concerning Mark's re-election? I now put the resolution to the meeting. If applicable, please mark your blue voting card for agenda item number 4. Agenda item number 5 concerns the approval of a dividend substitution share plan, or DSSP. It's the last item on business of this meeting, and the company proposes to introduce a dividend substitution share plan, or DSSP, which will provide an alternative to the existing dividend reinvestment plan, or DRP. It will offer an optional method by which eligible shareholders may elect to receive additional ALI shares as an alternative to receiving dividends. Whilst this may be attractive to some shareholders, we do not expect that a large number of shareholders will participate in the DSSP, as participants will not get the benefit of franking credits. Shares received under the DSSP should not be subject to Australian income tax at the time the shares are allotted, as the shares are likely to be deemed not to be a dividend. The shares issued under the proposed DSSP, however, should be subject to taxable gain or loss, which may arise on subsequent disposal of the additional shares and the participating shares. To be clear, today we're just asking you to vote on whether to introduce the dividend substitution share plan as an option for shareholders to consider, and it is not a vote on whether you personally enter the DSSP. ALI has received a draft class ruling from the Australian Taxation Office in respect of certain tax outcomes for Australian resident shareholders who hold their DSSP shares on capital account. The ATO has indicated that will issue a final class ruling if consent for the DSSP is obtained from ALI shareholders today. We have received queries about the difference between the current Dividend Reinvestment Plan, or DRP, and the proposed DSSP. Whereas under the existing Dividend Reinvestment Plan, participating shareholders receive a fully franked dividend, which is then automatically reinvested into new ALI shares. Under the proposed dividend substitution share plan, participants will not receive a fully franked dividend, but instead will be issued with new shares, creating a tax timing difference. A full description of the terms and conditions of the DSSP was provided in the notice of meeting. I now move the motion that in accordance with Clause 95 of the company's constitution, a dividend substitution share plan be made available to eligible shareholders of the company. Can I ask that any shareholders who wish to ask a question regarding this resolution, please make their way to the microphone. For your information, details of the proxy votes received on this resolution appear on the screen. A simple majority greater than 50% in favour is required to pass this resolution. Are there any questions on the DSSP? I now put the resolution to the meeting. If applicable, please mark your blue voting card for agenda item number 5. Thank you. That concludes the formal business of today's meeting. The poll will remain open for a short time after the meeting to allow you to submit your votes as you leave. We will announce the results of the poll to the ASX later today. If there's anybody who requires assistance with filling in the voting papers, please ask one of the representatives of Argo Infrastructure or Boardroom. I declare this 8th annual general meeting of the company closed. I now invite you to join us for refreshments, and please make your way out the door and turn right, as you probably all understand, towards the river. Staff will direct you if needed. Please feel free to wear a mask if you wish, but if you choose not to wear one, that is fine also. Please do not forget to place your voting paper in one of the ballot boxes as you leave. Thank you very much for your attendance today, and I look forward to having a chat with you out in the foyer. Thank you.